So today's Cardinal Lesson, this is my favorite subject. We're talking about tax-free. So with the investments that you can make and in your retirement planning, we have taxable, we have tax-deferred, and then we have tax-free. So we have other videos about that. Today we're going to be talking about tax-free accounts. So what you've done here is you've paid the taxes before you put the money into the account. And then once it's in the account, if it's set up properly and managed properly, you're not going to pay taxes on that money again. And even your heirs are not going to pay tax on that money again. So it's pretty cool. And we're going to be comparing in today's video two different sources or two different types of accounts that you can set up, which once the money's in there, again, if they're set up properly, they're going to be tax-free. And that would be the Roth IRA or the Roth 401k or the Roth qualified plan. And then the second one that we're comparing it to is the cash value life insurance. And so I want to pass it to Tom, and I want Tom to tell us like why we're doing this video today, why this is so important.
Yeah, I mean, we're doing this video because no one likes paying taxes. I mean, no one. I have not had one person come through these doors that say, I really want to pay more in taxes. And so, what we do is what we have in this video are two strategies, two ways to set up accounts that the growth can be tax free. It produces tax free income in the future. And then, like Hans had mentioned, your heirs receive it tax free. So, again, it's not with all your money, but with a portion of it. I think this could be really useful, built as part of a larger strategy. So, let's bring up the show notes. You can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board, and then the majority of the show notes is really this illustration for the life insurance policy, which is on the right side of the board. I'm not going to spend a lot of time here. There's a lot of details you can see, but if you want to go study this a little bit more closely after you've watched the video, go to the show notes. We have all the information on that policy that we'll talk about here. So I'm going to turn it back to Hans, and we're going to go one by one and really just show you the difference between the Roth IRA and a life insurance policy, where they differ and where they're the same.
Yeah, so I want to cover first what I forgot to put up here as the bullets, which Tom brought out during the preparation for this meeting, is a Roth IRA has limits as to putting money in there. I mean, you're limited annually, you're limited by your income, whether you can put it in there or not. Once it's in there, we have the availability to do a Roth conversion, and we're going to be talking about that later. A lot of people come to us at retirement, and you're limited in your Roth conversion amount by the whole amount you have in your IRA. And you certainly wouldn't want to convert the whole thing in 1 year, mainly because of these tax rates. With these tax rates, you wouldn't want to take an IRA, a large IRA, and just do a whole conversion in 1 year, because it would shoot you up into a very high tax bracket. It would kind of defeat the purpose. So we want to show the comparison, which I didn't get the bullet point up there for, is you have limits and rules as to how much you can put in a Roth IRA, how much you can convert, how much you can increase the balance. With cash value life insurance, you have no such limits. You can put as much as you want in. You have some limits that you got to spread it out over 7 to 10 years when you buy one of these policies. So you can't dump a huge amount, but there's no limit to the amount annually that you can stuff in there. So I want to put it to Tom, and I want him to discuss that first difference between the two.
Yeah, I mean the Roth accounts, like Hans had mentioned, especially when you're younger, so someone similar to my age, right? There are limits on how much you can put in there, and we have other videos where we talk about that. There are no limits on the life insurance policy, and I think another important part here is on this whole video is this isn't an either or situation, right? It's not you have to pick one or the other. Is you could have a mix of both. So you might have someone who has a high earner, they're doing well, and they've maxed out the amount of money they can put into their Roth accounts. Again, if that's what they're wanting, and they're looking for other areas to put their money, life insurance is a great other option to shield some of that money they have into tax-free accounts. And so again, that's just one scenario where that could be useful. But even when we have retirees, this isn't an either or situation. Hans has both personally, right? He's got money in a life insurance policy to access tax-free. We'll talk more about that later. But he's also has money in the Roth, right? It's kind of either thing that's is available. I think it's important to understand that difference there. The other difference we were talking about a little bit is, we were sitting down trying to think through, are there any other accounts that are tax free out there? And we really didn't come up with any other ones. Maybe, tax exempt bonds, but again, there's some limitations there. I did come up with one, offshore accounts in the Bahamas, but again, now you run the risk of going to jail, so we want to avoid those. But really, these are kind of the two main ones that you have available to build tax-free, the growth to be tax-free.
Yeah, so let's go down the line here and compare them. Where they're similar, they both have tax-free accumulation. I mean, that's one of the reasons you do the Roth conversion. So you pay the taxes up front. Once the money gets in there, it's going to now grow, and you're never going to pay tax on that growth. I mean, it's just and if you hold that thing till you die and it goes to your heirs, they're not going to pay taxes either. So that you've got tax-free accumulation. Life insurance, cash value life insurance, if it's set up properly and it's managed properly, you're not going to pay any tax on the accumulation of cash value either. So, Tom?
Yeah, I mean, I think that's exactly right. So, with the Roth account, the growth is tax free. There's some rules around when you can access that. So, don't go put money in and immediately take it out. So, just be cautious there. But similar with life insurance, right? You put the money in, it's growing. Whether what we have in the show notes is a whole life policy that has dividends that are paying into the policy that then grow tax free, right? I mean, then so when you pull them out, again, if done properly, you can access that growth tax free. And just as an example, like my parents moved to be closer to us, about 2 years ago, maybe 3 years ago now. It's been several years, but they were in the process of selling their one home, wanting to buy another, trying to time all that right. And what they ended up doing is taking a loan against their life insurance policy to access the cash value, so they could put it, buy the house. Then they sold their other one, and then they paid it back, right? I mean, that's something that we've seen done. And then, for example, Hans, when he was starting this business at Cardinal, he took money out of the life insurance policy as sort of the seed money to start the business. As we start becoming profitable and doing well, he paid it all back, right? There's a nice, and we'll get to that point a little bit later down the board. The point being, though, is the growth on that money in both accounts are tax free if you follow the right rules and access it properly.
Yeah. And so the next point about the tax-free to heirs, we run into a lot of very middle income people who they have a social security check, and then they have some other savings, and maybe there's a couple, so they got two social security checks, some other savings, and maybe they don't even have a large IRA, but they have a smallish one, or it doesn't really matter what the amount is, 100,000, 200,000, 300,000, 400,000 or more. And when I'm asking them what that IRA money is for, they say, well, I'm going to give it to my kids. I mean, I'm just going to hold it until I die, and then to just take the minimum out of it. I'm not spending it. I'm not living off of it. And it's going to go to my kids. And what a lot of them haven't really thought about is their kids are in a much higher tax bracket than they are. A lot of retired people that can live off their Social Security and maybe some other money, they don't really need that IRA money that they save. So it's just going to go to the heirs. And when they're in a very low tax bracket, a lot of these people that I'm speaking about are in the very low tax brackets. Their kids are in the high tax brackets, whether they're single or married. And so they can start doing a Roth conversion of that IRA year by year. And we do this with them and for them, where they just over a period of years, these people might be in their 70s, late 60s, late 70s. We can convert that thing slowly. So when they pass away, it's going to go to their kids tax free. They will have paid very low taxes on those conversions. So it's just a point that the tax-free distribution at death is a real advantage to these two things. And the life insurance, because that's what life insurance is all about, is if the person bought something like this life insurance policy that we're going to talk about later, or in an amount the size of the IRA, and use the IRA money to pay the premiums, then their kids are going to get the death benefit, or their heirs or their spouse or somebody tax-free. So, Tom?
I mean, I think that's a great point. I mean, a lot of times we have people walk through our doors. They've become great savers, right? That's why they have the money they do, and they really have no intention of spending it all, right? I mean, even if they wanted to, they're just based off their lifestyle and what they spend money on. They're just not a real situation they're going to do it. And so now we start thinking about legacy planning. Like, okay, if you're not going to spend it, assuming we have all sort of the risk covered, where is this money going to go? Most times it's going to their children if they have kids. And so, how do we want to leave that to them? And what kind of taxes are we going to leave them with? And most times people don't want to leave them with a huge tax bomb of a lot of money left in like a traditional IRA or a 401k. And so both these type of accounts are ways to leave money tax free. One of the differences between the IRA and the life insurance is with the Roth IRA, if you leave that to a child, uh, typically an adult child, now they have 10 years they have to distribute that money from. By the end of that 10th year, it has to be emptied. That Roth account has to be emptied. But what that also leaves them, that gives them 10 more years of potential tax-free growth, right? If they don't need it, they can leave it in there and get 10 more years of growth. With the life insurance, that death benefit pays out tax-free. That happens upon death, or shortly after. And so that is a difference between the two, is they don't have that 10 more years of potential tax-free growth. Now, if they need the money in both scenarios, they're going to pull it out, and that's really not that big of a difference. But if they don't, the Roth gives them a little more flexibility on 10 more years of tax-free growth.
Most of the wealthy people that I've come in contact with and worked on their finances, they have both, and they got lots of life insurance. And that tax-free transfer to their heirs is a real benefit. Now let's talk about tax-free withdrawals, because when we're talking to retirees, some of them are setting up the Roth IRAs so that their kids will get a tax-free inheritance. And like me personally, I've set up my Roth IRAs so that it's going to pay us a tax-free income for my wife and myself for the rest of our life. Okay. So this tax-free withdrawals is my main motivation. And then, if there's some left in there when we die, it's going to go, of course, tax-free to our kids. But I also own life insurance, and I have the ability, I've done it twice, where I've tapped these very large life insurance policies that are stuffed with cash value, that I've not paid any tax on the growth. I've borrowed against them at what works out to be 0% interest, and then I've paid it back. And I really don't intend to spend that cash value in retirement. Or another way to put it, this is going to be the last money that I spend because of the tax-free benefit. So I'm not going to do this. I'm not going to do the withdrawals, most likely, because I want the tax-free benefit or the face amount or the death benefit to go to my children. So, Tom?
Yeah, I mean, I think one of the earlier point was about leaving money to the heirs. Some people say, "Hey, that's not my top priority. Yes, I care for them, but that's not where I want my focus to be." Or maybe you don't have any kids, right? Maybe you're married or you're not, and you don't have any children, and you want to spend some of this. You want to enjoy it, and then the withdrawals, the tax withdrawals, become pretty important, right? Is it doesn't impact, and this is the next point down. So I'll jump ahead a little bit. It doesn't impact any IRMA cost. That's that extra cost for Medicare. It doesn't impact your taxation on Social Security. It's not driving you up into higher tax brackets, allowing you to keep more of your money. Because at the end of the day, the whole goal of creating an income is the less taxes you pay, the more you get to keep and the more you get to spend, right? And that might be your focus. And so both accounts allow for tax-free withdrawals, where you're not having to pay any taxes or worrying about how it's impacting anything else that's going on.
Well, good point. I mean, you can make withdrawals out of either of these tax-free accounts. So you've got a Roth, and you need money to live later in life, and so you're going to take some of that income out of the Roth. Maybe if you still have a taxable IRA, you're going to take some of it out of that. You can balance this each year. We help people do this where you take a little taxable, a little tax-free, and you manage that and combine it with your Social Security check, and you put all those things together. Your Social Security faces taxes, and the taxes on your Social Security are calculated by your other income. That's a lot of my motivation to have all this tax-free money coming in on an annual basis or a monthly basis for the rest of both my life and my wife's life, because the Social Security works the same way. It comes in as long as you live. When the first one of us dies, we'll go down from 2 Social Security checks to 1, but that 1 will be mine, which is quite large. And I don't want a big tax bite out of that Social Security. And the way I can dodge that is by having my withdrawals or living off of a tax-free Roth as we age. Okay. And then you also have this thing with Medicare called IRMA, which we have many other videos on that. But if you start looking forward of managing IRMA through all of your retirement, and you're facing big required minimum distributions, that shoots people up into IRMA and keeps them there for the rest of their life, especially if it's a widow that's having to make these, or widower that's having to make these withdrawals in their 80s, and they're now down at single taxpayer rates, and then they're at single IRMA rates. So this is a big reason to have a bucket or perhaps 2 buckets of tax-free money available to you, because you're going to have other income that doesn't drive up these Social Security taxes. Tom?
Yeah, I mean, I think one of the ideas that in planning and sort of when we look to the future is having different money that's taxed differently gives you options when you retire, right? Is if you have money in a taxable account, some in a tax deferred account like an IRA, a traditional IRA, some in a tax free account like the ones we're talking about today, is it gives you a choice of where you pull that money from to create the income. And when you have ability to pull it from each, you can really manage the tax brackets very well and keep you in very low tax brackets. Um, Unfortunately, what most people we meet, they don't have a lot of money spread around these different buckets. They have it mostly in, most of the time, it's in traditional IRAs or 401ks, which is great, where you've done a great job saving. You have all this tax deferred money. The problem is now when we start pulling money out, it's all taxable income. And if we have some emergency come up, some reason we need a big chunk of money, we have to go to that account because that's where the money is, and it drives you into tax brackets. It brings in other issues like the IRMA and the taxation on Social Security, and it sort of compounds on itself. And so having money spread across different buckets that are taxed differently gives you a lot of choice and options in retirement, which makes for a smoother transition. It makes where you can really control and get really precise with what the taxes you're going to pay on a year-to-year basis.
Now, a Roth IRA can be transferred to an annuity with guaranteed income for life, and that can be on 2 people. That's the way I've set up mine. And so, well, that's a mouthful. So first of all, we've got a tax-free account. So we're not going to pay any more taxes on any withdrawals out of this account. But then there's a lot of people that are afraid to withdraw their money because they think if they take too much and then they live too long, they're going to run out of money. So an annuity that has a guaranteed lifetime income on 2 people. So if just one of them outlives the odds, or just lives into their 90s and beyond, this is going to be the best choice they ever made, is by putting it in an annuity. But if you put the Roth into the annuity, or you turn the annuity into a Roth IRA annuity, then these lifetime payments are going to be tax-free for lifetime. So again, that's a mouthful. And I can do one better than that, is you can put it in the annuity as a regular IRA. So you could take like $500,000 and move it from the IRA into this IRA annuity that promises a lifetime income whenever you want to start it, but it's a taxable IRA. It's a taxable, pre-tax, tax deferred. But then you can convert this annuity in chunks according to a schedule. I mean, we'll just lay that out for you so that by the time you start taking payments out, the whole thing is in a Roth IRA, which makes your lifetime payments forever tax-free. So, Tom?
Yeah, I mean, one of the things, and we have other videos where we talk about these annuities that can create an income, because really what that allows you to do, or what most people are missing when they retire, is they don't have this income set up, right? They have Social Security, it's not enough to live off, and then they have this big pot of money in an account, and they don't know how to create an income off of that, right? They don't know which ones to sell, they don't want to worry about the market fluctuations, and so taking a portion of that, putting it in an annuity, is a way to guarantee an income, which is really what they're missing in retirement. And so that piece of it is nice. And then if you do that inside of a Roth account, like Hans has done, now that income is tax free. So now you get to keep all of that income. You don't have to pay some of it back to the IRS or the state if your state has a state income tax. And so again, it's just a way to solve a bigger problem as part of the larger plan of creating an income. If we're doing it with Roth accounts, you can do it within a Roth IRA. Again, this is a difference between this and the life insurance. Technically, you could maybe do it with the life insurance, but now you're giving up a lot of the benefits that the life insurance has. So for the purposes of today's conversation, you really wouldn't want to do it with the life insurance policy. That's really more focused on the Roth IRA as for today's purposes.
Yeah, and we could set up an income out of the life insurance. It just wouldn't make sense to transfer it to an annuity. You could do it, but it generally doesn't make sense. You're giving up too much. So now you've also got, there's, with the Roth IRA, there's no long-term care benefits, and there's not a life insurance benefit. So whatever's in the Roth IRA is certainly available to spend on long-term care, is if you don't have insurance, or you can spend your money and you can spend it tax-free, but there's no extra benefit for long-term care. Same thing with life insurance. Is you got the money in the Roth, it grows tax-free, you die, whatever's in there goes to your heirs. When we get over to the life insurance, there's lots of enhanced benefits for long-term care. And the example we're going to show you is you can get at the death benefit while you're still alive and the living benefits, and pay some money tax-free toward long-term care. So that's a real benefit to this. Secondly, when you pass away, there's a larger benefit of the life insurance called the death benefit, or the face amount, that goes to your heirs. So that would be an advantage to the cash value life insurance side as opposed to the Roth IRA. Tom?
Yeah, I mean, I think that just gets to the heart of what a life insurance policy is, right? I mean, life insurance at its core has a death benefit that pays to the heirs tax free. And the other thing, you can add riders on that, like a chronic illness rider or other things that then can pay for long term care, right? Coming out tax free to pay for long term care. You don't have any of those options inside the Roth IRA. Granted, like Hans had mentioned, you could use the money to pay for it, but you're not getting any of that leverage that the insurance company is providing inside the policy. So again, that's just a difference between the two. It doesn't make either one bad or good. It's where they're different. The types of policies are different. And again, ultimately, when you're looking at these, it needs to be part of a larger plan, and making sure that what you have makes the most sense for you, as opposed to just, oh, I like life insurance, let me put it all there or all in Roth because I don't like whatever your situation is, right? It needs to be thoughtful, it needs to be the appropriate mix, but a lot of times it makes sense to have a little bit of both.
Okay. Now, with the Roth IRA, you can invest in most anything that's IRA acceptable. If your IRA custodian allows it, you can invest in it. And, we manage money for people, and we have accounts where we set up Roth IRAs, and people are invested in a number of different things, and the flexibility of that. And we typically, when people have both Roth IRA and traditional IRA, we're going to put the riskier, if they're going to take risk, we're going to take more risk in the Roth side or the Roth IRA than we do in the traditional IRA, simply because they're going to leave it there for a long time and they're not going to pay taxes on the growth because it's tax-free from then on. So when we're balancing risk and then investing in general, we can put it in just about anything that's acceptable with the IRA custodian. Now, with the life cash value life insurance, you're going to be limited to what the policy allows you to invest in, which is generally the general account of the insurance company, which, by the way, is very conservative. So in the example that I'm giving down there, it's almost 4% internal rate of return at 85 on the cash value. It's a little over 5% on the death benefit at 85. So I'm just quoting some numbers. Those are internal rates of return, which is a bond-like, very conservative rate of return. So we're going to put this as a possible disadvantage to the cash value life insurance is you're very limited in the investment choices. Is, in the Roth IRA, you have a wider spectrum. Tom?
Yeah, I mean, I think that that is a pretty big difference between the two, right? Within the Roth, you have a lot more investment options available. You could be more aggressive, which on the upside is good. You can earn more money, but it also brings in the risk of loss, right? When you take risk, you could, you're taking it, but there's a risk of loss there. And so, where the life insurance can be helpful is with a portion of your money. If you want something that's safer, a bond like investment, it's not bonds, but it would be the substitute as part of the bond allocation in your portfolio. Having some in life insurance that is not correlated to the market, meaning it's not doing what the market's doing. It doesn't matter what interest rates are doing, because how the cash value in this policy works is the dividends on the life insurance policy, and those just come in each year and it's adding to the cash value. It's a way to have something that's moving differently than the market. It's not taking on as much risk, but also you're not getting as much of possible return. So that needs to make sense as part of your plan when you're considering either option here.
Okay, so we talk about strategic Roth conversion, and this also could be strategic life insurance, cash value life insurance accumulation. Key in on the word strategic. And what we're going to use is these tax charts. And these are the 2025 tax brackets. And so if we have a single person, a lot of people are going to use the top of the 24% bracket. So for a single person, that means an adjusted gross income of $197,300, almost $200,000. So we take their income, if their income is 80,000, and then we look at 200,000, that means that we could convert 120,000 this year and still not get into the 32% bracket. And it's in my opinion that taxes are on sale right now. They were scheduled to increase in 2026, and then there's talk and there's bills floating around Congress where they're going to extend these tax rates or these tax brackets on into the future. So for right now, we're thinking that's probably going to happen. But for right now, we're going to deal with the top of the 24% bracket is almost $200,000. In a married couple, the top of the 24% bracket is $394,000. Now, that doesn't mean that if you're a married couple and you have an income of $100,000 a year, we're going to tell everybody to convert $300,000 of their IRA over to a Roth in that year. I'm just using these. We use these as a guide, and we share them with people when we're picking the amount we're going to convert year by year by year. So, with that understood, when we're trying to get money into the Roth side, we're sort of limited by the amount of the tax bracket that you're willing to accept. Tom?
Yeah, I mean, I think we have a lot of videos where we talk about the Roth conversions. The whole idea is we're trying to get money out of traditional IRAs, traditional 401ks at the most tax advantaged way possible, right? And that might mean paying more taxes now than you otherwise would have to avoid higher taxes in the future. That's really what you're doing with the Roth conversions. And so it's important to look at the tax brackets. Like, where do we fall in the tax brackets? Like Hans had mentioned, a lot of people, that 24% is a real attractive tax bracket because it's only 2% marginally higher than the bracket before. It goes from 22 to 24, and it's pretty wide, right? You can have a lot of money, earn a lot of money, and stay within that bracket. So that's a pretty common one to use. Not all the time, right? Sometimes we're doing lower brackets, sometimes higher, just depending on the client situation. But you want to be thoughtful about how you're doing this instead of just converting it all at once, throwing you into the top tax bracket. That kind of defeats the purpose, right? That's not what we're going for. And then as it relates to sort of what we're talking about here on the life insurance and the Roth IRA, a lot of times we're meeting people right at retirement. They're no longer working, so they don't have new money to add to these accounts. What they do is they have a pot of money that they've saved, and we're trying to reposition it and taking advantage of the tax brackets, getting it into one of the two types of accounts for future tax-free access, whether that's to the heirs or for them in the future. And we need to be mindful of where the tax brackets are to make sure we don't push them into higher tax brackets now to avoid taxes in the future.
Okay, so now we're going to talk about the cash value life insurance. And I came up with an example that I feel like a lot of people can relate to. If this looks like too much, cut it in half and get a $125,000 life insurance policy. If this looks like not enough, it's a $250,000 life insurance policy. You can double it, triple it, quadruple it. It's the numbers are going to be pretty similar. They're linear. There'd be some slight differences when you mess around with it. But let's just understand this thing. So we took a 65-year-old man who is a standard non-smoker. That means that he's charged the rate at standard. And that's somebody that can have some high blood pressure. They can have a little bit overweight or moderately overweight. They can have cholesterol. They could even have well-controlled type 2 diabetes. I mean, there's a whole lot of generalities. As long as nothing is running serious on them, you're going to fit in standard. And you also have people that are in very good shape. They don't have much in chronic illnesses. They're not on many medications. And they're still going to end up in standard just simply because of their age. Now, there's a preferred class, which would make all these numbers look better. I have a hesitancy to quote that to people. You're going to get that if warranted. But this is the thing for an example. If you're 60 years old instead of 65, these numbers are going to look a lot better. If you're 70, it's going to be more expensive. We write life insurance on people 70 years old, 75 years old, and a lot of it for more than just the death benefit. I mean, we're doing this cash accumulation. So in this example, this 65-year-old example, he's going to pay a premium of $23,670 annually for 7 years. And where we're going to get this money typically is out of the IRA. So, it's going to take about a $30,000 to $32,000 withdrawal from your IRA to pay the taxes and then net the $23,670. And you're going to do this for 7 years. And it's going to be similar to a Roth conversion, is that over the 7 years, you're going to pay in $165,692. And the cash value accumulation at age 85 is $319,807. So that's money that's available to you that you can do through a borrowing strategy that the interest rate is going to be a net zero. I mean, I can explain that to you in other videos where we're only going over this. But that's how much cash is available to you. First of all, if you wanted to borrow it, if you want to take a chunk of it out, if you want to set up an income that's making payments to you, you could do it before 85. I'm just using that as a point in time. The death benefit at 85 is going to be $377,345. The death benefit has grown over the 20 years, by more than 50% because of the dividends that are all left in the policy, and that has a way of increasing the death benefit. So $23,000 a year adds up to $165,000 over 7 years, then no more payments. There's slow cash value growth. It's a very conservative, safe investment, and then a death benefit of $377,000. And that death benefit will continue growing if you're staying going at age 85. You also have a long-term care or a chronic illness. It's not really a long-term care benefit, it's a chronic illness. So if you have the same qualification as a long-term care claim or a similar qualification, you're able to access the death benefit while you're still alive so you can use to pay for long-term care expenses. This is the underlying theory, because we have a number of policies that we sell and we talk about in different videos that are engineered to be a long-term care policy. And it's under the same tax laws, the same strategy. It's just more of a long-term care emphasis. The emphasis on this policy is stuffing in as much money as you can over 7 years so that you could have access to the cash value and the grown cash value later. So I want to pass it to Tom.
Yeah, I mean, I think some of the important things to remember, right, is this premium is for 7 years and then you're done, right? It's not like you have to keep paying this for the rest of your life. You could structure a policy that has a longer payment. Instead of just 7 years, you pay it over 10, 15, 20 years, whatever the time frame you pick, which would lower the monthly amount or the annual amount. It would lower the premium. What's nice about paying it over 7 years is you've done it. You're done with it. It sits there. You can sort of set it and forget it. It goes into the future with the dividends, and it's a really sweet deal. Again, the cash growth isn't something that's you're going to get super excited about from a percentage standpoint, but when we compare it to like what bonds have done historically, it's a pretty good bond substitute as part of your overall portfolio, and you get some of these other benefits. God forbid you die in the first 1 or 2 years of having this policy, the rate of return on this would be outrageous, right? It would be huge because you're getting that full death benefit by only paying a little bit in. So you are getting the life insurance component along the way. If you live a long life, it's grown to be a higher amount in the future. And it really is a nice part of an overall plan when we look at sort of where to put some of your dollars and how to invest them.
Okay. In terms of your overall plan, we've figured out a way to make your Social Security check either tax-free or very low tax. We talked about IRMA, reducing IRMA through the use of tax-free. We talked about long-term care in terms of the life insurance allowing for early use of the death benefit. This whole video has been about Roth IRAs and your IRA portion of it. We talked about income and your income and tax-free income. We talked about your estate plan in that we're wanting to pass along the tax-free to your heirs, where they're going to inherit tax-free money and not have to pay taxes on it. And then obviously we've talked about taxes through the whole video. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And I thank you for listening.
Thank you.